let's get to our guest analyst, and it's going to be Mr. Craig Bolanos. He's the co-founder and wealth manager at VestGen Wealth Management. Thanks for being on the show, Craig. Hopefully you had a good day off yesterday.
Listen, I had a fantastic day off. I'm celebrating holidays, rolling into a long weekend here, but you know what, Scott? What's not to like? The Fed still left those rate cuts on the table. The world hasn't broken out into World War III yet. Earnings, I think, are going to be surprisingly resilient. We'll find out in just 2.5 short weeks. It's looking good.
Yeah, what did you think about Powell's testimony? What were your takeaways?
You know, I was disappointed that he acknowledged that the economy is going to slow, but we all kind of knew that. But to hear those words, you know, it bugged me a bit. You know, his comments relative to inflation, clearly he's hedging on the oil prices and everything else. I mean, boy, we were sub $60, under $60 for a while until we track back into the mid-70s. But you know what? I think this has a long way to go before we want over the magic 86 number, which is where it really starts stomping out some of the economic activity. So I think this, too, shall be okay. We'll get a rate cut in September, do a follow-on act in December, but they did take away a couple of those future rate cuts. So I got news, everybody. We'll get 4 cuts over 2 years, and that's probably going to be about it.
Yeah, I'm sure there's probably some people that are disappointed out there. Pulte, he's I don't know, what's his job? Do you know, in the government? He's a home builder, but he's mad about interest rates not being cut sooner, faster, harder. There's a lot of folks looking around that 3.5 level right now. We're at 4.25 to 4.5, right? So I suppose we're about 75 basis points too rich to the upside, but. How much does that help the market, the government's balance sheet? I mean, if we got down to say 3.5%, what does that world look like?
Well, I mean, if we get down let me change my tune. When we get down to a Fed funds of 3.5 to 3.75, you know, that's 75 basis points of cuts. That's 3 separate meetings because I think they're only going to give it to us a quarter of penicillin at a time. I think that is going to help the housing market on the margins, but that's where winning about. Winning is about on the margins. I think in addition to that, it's going to help some of the corporate credits that are out there. There's no doubt about that. So I'm looking forward to a day, but we're never going to return to ZRIP. And I think the longer we hang out here in a return to normal, the better off we are, so people can unanchor from that recency bias of those zero rates.
Yeah, and when you say that ZRIP, that's a zero interest rate policy, and we were there for a long time. But there is a story, now that you say that, on Zero Hedges. Wow, it came out yesterday afternoon, I suppose, about not ZIRP coming back, but NIRP. Do you remember NIRP? Negative interest rate. Negative interest rate policy is back as the Swiss National Bank cuts rates to zero and introduces stealth negative rates. How about that? So there was a time we had probably $17 or $18 trillion of negative interest rates, bonds priced at a negative for a while there around the world in total. It wasn't very long, and then obviously things kind of started to recover. But that's back when people were still getting mortgages at 2.5%, and the only real good municipal real good government was that's when Ireland, they floated a 100-year bond at 1% and got it all, which looks to be the trade of the century right now. But interesting that the Swiss National Bank going to zero, so they got the ZIRP and they're looking at NIRP. So keep that in the back of your mind. I might actually do that on my show today. We'll see. But it's hard for people to get their head around putting $10,000 in the bank and getting back $9,950.
It's really hard. I mean, I'm having acid flashbacks on a Friday. That almost reminds me of when we went into contango on the oil prices, if you remember that. So much financial engineering. As you tell me that story, it begs the question, maybe we all ought to get off these fiat currencies and back to some form of a standard. After all, it wasn't that long ago, just 50 years, that we had a gold standard in the U.S. I don't know that I'm advocating for it. The Fed has most certainly been my friend. The rule of don't fight the Fed, just like don't fight the tape, just like new highs make new highs, those have been good analogies for so many. I just don't want to continue to always buy the dips, because one of these days it's not going to be friendly.
All right, brother. We're going to use that as our kicking off point. Thank you very much for coming on the show. Have a great weekend. Hopefully yesterday was okay for you, too. It's Mr. Craig Milanos coming to us from Chicago. He's the co-founder and wealth manager at VestGen Wealth Management. We're going to go away. We've got a couple of texts. We're going to come back and talk more right after this.